Webinar Wednesdays. If it's Wednesday, there must be a webinar happening somewhere. So today we got a great program that a lot of people asked at the SBDC, hey, what about lines of credit? And how do I get a line of credit? And so today we hope to answer that question for you. I'm Kelly Bearden. I'm the director of the CSU Bakersfield Small Business Development Center. And happy National SBDC Day. So I get to kick things off today and talk a little bit about lines of credit, and then I will shortly introduce Michele McClure of Pacific Western Bank, where she can talk about some of the unique and very creative loan programs for lines of credit that they have. But first, let's get a little background of lines of credit and some of the competing types of funding that's available for startup and actually existing businesses. So a line of credit defined by what I consider to be the Bible of financing growth is the Handbook of Financing Growth, and they define a line of credit, also called a credit line, as an informal loan arrangement between a bank and a customer, allowing the customer to borrow up to a prescribed amount. So with that, a couple things. I've never really considered any type of loan agreement to be informal, so I was kind of taken a little bit back about that. But it is a loan up to a prescribed amount that is specified in the loan arrangement. Some of the facts that come up on credit lines. Number one, credit lines are not for startup companies. Very, very seldom will you see a startup company that needs a line of credit. Generally, a company needs to start up and gain traction, perhaps through the use of permanent working capital that we'll discuss. And a line of credit comes when there's actually shortages or longer period of times when revenue is received. One of the classic examples of a credit line is a farmer. And a farmer is one who will maybe sow their fields in the spring and irrigate and tend to those fields. And then in the fall, they reap a harvest and receive all the money for their particular product at that one time. So even though we're not going to talk much about agricultural credit lines today, that is really a classic example of how one works, about how you put in so much time and effort and expense and then receive the money at the very end. And that's a classic example of a credit line. Another would be if you're actually doing, if you're a retailer and you sell a lot at Christmas time, hopefully you do if you're a retailer, and it's necessary for you to get that inventory in. So oftentimes you might be able to, you might need to buy the inventory as early as June or July and pay for it then and bring that inventory in to sell in a very short period of time in November and December, and then pay that off and hopefully retain a profit after you do that. So that's a couple of classic examples about how they work. I always recommend that people start with their existing banking relationship. I don't know if our guest speaker agrees with me on that, but it's always best to start, and she is nodding her head accordingly. So it's always best to start with the relationship that you already have and see what your bank can do for you. Some of the pros of lines of credit is oftentimes, at least at the SBDC, we notice that they're easier to get than a term loan. Sometimes some banks have specials in it, and they just seem to be easier than a term loan in many cases. Another benefit of a credit line is you only pay interest on the amount that you are borrowing. So whereas a term loan, you might pull in $100,000 and only need 20 of it right now, and 80 of it's sitting there, you're still paying interest on that $80,000. So you only pay the interest amount on the amount that you are actually using or borrowing at that time. A nice thing also is you build credit. You build credit, business credit for your business. And also you establish a banking relationship, which is very important moving forward. There's a great deal of flexibility that is obtained through a credit line. And one thing that we find also at the SBDC is it adds a level of security when your business is prospering. And one of the the things that we saw just about a decade ago was the Great Recession. And a lot of businesses weren't positioned, even though they were very profitable leading up there, to survive the recession. Now, I've heard a couple of economic forecasts. It doesn't sound like anything is imminent as far as the decline or demise of our economy. But one thing that I do know that is, if I had a business that was doing well right now, I would look to get a line of credit set up, if nothing else, is for a rainy day fund. So that is best to do when your business is successful, it's profitable, and it is actually succeeding. And my last pro of line of credits is that it enhances cash flow. And obviously, by being able to inject debt into your business, it does add to the cash flow aspect, which ironically on my next page, I'm going to have as a con, is cash can harm cash flow. So, but there are cons of a line of credit. There's an annual renewal is oftentimes, and I'm not talking about our presentation today, I'm talking about in general of what I have observed over many years of working with lenders and also clients seeking lines of credit. But many of those will have an annual renewal. They'll have an annual credit analysis that is done at that time. In many cases, the line of credit needs to be cleared and on an annual basis. And by cleared, I mean, if you have, again, a $100,000 line of credit, sometimes many banks will have you actually clear that line of credit down to zero. And it must be maintained for a specified period, maybe 30 days or so. And that's just so it is used in the manner, I believe it's used in the manner that it's intended, as a line of credit that revolves rather than a term loan, which is not what the focus is today. You will have free fees and charges even if you don't use the line of credit, but still having that security in there. And if you have too many lines of credit or you don't do a proper analysis before, if you can sustain and handle the added debt that you would be taking on, even if it is only for a short period of time before your line of credit revolves, could harm your cash flow of your business. So one of the lenders that we work with is in rural communities, and it's RCAC, excuse me. And what they are is they are a nonprofit community development financial institution, and they're capitalized and they work in populations that are 50,000 and less. And the reason I bring up their particular line of credit today is because it is one that works really well in rural communities. And oftentimes the line of credit doesn't work as well if the lender doesn't have a banking relationship in that community. But they're one that goes all over the United States in rural communities and works with populations of less than 50,000, of which for us even includes Shafter, Delano, and Shafter and Wasco, and perhaps into Arvin and out to East Kern and West Kern to Taft, and south down to Fraser Park. So all those areas are covered by their particular loan program. And they do a line of credit and other types of programs. And if you need any information on theirs, just contact us at the SBDC and we'll put you in touch with the appropriate person. Some of the things that are not lines of credit that are somewhat related to them, and oftentimes lenders or borrowers, not lenders, but borrowers confuse that type of funding is factoring. And factoring is basically borrowing against your accounts receivable. It's borrowing against the money that people owe you. And it is not a line of credit. It provides the funding needed for rapidly growing companies by the sale of your company's receivables, invoices, basically. So when you've done the work and you've incurred an invoice, oftentimes it takes many days or weeks, sometimes months, to get paid for that. Now, a line of credit is helpful to have been set up in advance of that, because then that line of credit would have been able to maybe cover you until you get paid. But oftentimes people will take their invoice and at a relatively high fee, they will actually turn that invoice into cash. And there are instances of where, at the SBDC, we recommend people do that, because oftentimes, even though it is high, if they only use it on a limited basis. It can be habitual, what we find in some of the commercial trades and some of the construction businesses and those that do government work that gets paid over a long period of time. So it can get to be quite consuming. However, being able to turn it into immediate cash, if you're a contractor and you can't make payroll on Friday, oftentimes your guys are looking for another job on Saturday. So there are instances where it works well. We also talked a little bit about term loans, so we'll just define it real quick. And a term loan is very essentially, it's just a certain amount of money over a specified number of months or years, and then at an appropriate rate of return and interest rate. So you have those three factors: an amount, a interest rate percentage, and number of months, and then you amortize that loan out over those particular months in most cases. Your home loan is a good example of a term loan if you have one of those. So that's a term loan. And you know, some of the other products that are out there that kind of compare, there's somebody who just got a really high interest rate apparently. So some of the other loan products that are out there, credit cards, there's microloans, and some of the pros and cons, the biggest cons on credit cards, cost fees and non-cash flow. Microloans generally is a smaller amount. Online lenders can be very, very, very expensive. So please tread carefully. We get a lot of clients that come in that want to refinance debt that they got from an online lender. It's very, very difficult. And then an equity line is another example. And an equity line is tied to your real estate, but for startup businesses, that is an excellent source of maybe using your home equity through a line of credit in order to actually access that credit line. Okay, so now I'm gonna get to the pop quiz, and we're not gonna do it formally this time in the poll, but just the pop quiz. I need startup business expenses, some equipment and fixtures, maybe some furniture, along with working capital for my food business. So this is a startup food business that needs startup expenditures, equipment, fixtures. What would be the best loan for me? A credit line. B, factoring. C, term loan. D, any of the above. Actually depends on the specifics. Okay, are you thinking it over out there? I'm going to go with D on this one. And the reason is, depending on the situation, any of those work except for potentially the startup business expense. And that's kind of a trick question, as probably all my questions are going to be a little bit on the trick side. And that's because we threw in the home equity real estate where you could get the credit line off the home equity. And factoring isn't going to really be, but so I'm going to change my answer, and the best loan for you is going to be a term loan, C. Okay? Talked myself right out of that one. So actually you can check that one wrong for me, since initially I was before I thought it over. So right now I'm failing my own pop quiz. So I just got a contract, question number 2, through High Speed Rail to provide fencing services. Now this is fence construction. I just want to be clear on that. And what would be best for me? Would it be a credit line? Would it be factoring, a term loan, or any of the above? I'm getting a lot of feedback here, and the best loan for you would be a credit line, because the credit line is going to be cheaper than factoring. You're only going to use the amount rather than a term loan where you would be paying interest on amounts that you didn't use, and you would only use it until you got paid back, because High Speed Rail is a state of California project, and the state of California likes to pay people within 45 days, but oftentimes that doesn't happen. So you could be out over, say, a couple of months, and during that 2-month period, you're providing and paying your labor, you're bringing in the materials and paying for that. And so you're spending a lot of money before you actually get paid on that government procurement work at the end. So a credit line would be a very valuable thing to have. And that's going to bring us to our last question. Is I need capital to grow my existing energy base. I will be purchasing fixed assets, land, and a building. I may need a large sum for equipment too. Which would be best for me? Well, what we want to always do is we want to match what we're purchasing. And if we're purchasing land and building, that's over 20 or 30 years, with the appropriate financing for that. So that is not a credit line. It is not factoring. It would be a term loan. And the best source for that would be through Mid-State Development Corporation in the form of a 504 loan in most cases. So the correct answer for that would be C. So I got 2 out of 3 on that. I got 67%. Back in the day, that would have, I think for Michele and I, would have been a D+. Now I think things are somewhat relaxed, but D+, you know. I'm going to have to study and do a little bit better. And while I do that, I'm going to introduce our presenter today. Our presenter is Michele McClure, and Michele's experience as a banker dates all the way back to 1979, which I can attest was a very good year. Subsequent to landing at Pacific Western Bank, where she is a branch manager now, she's able there to provide financing and deposit services tailored for specific businesses with less than $1 million in gross annual revenue, all the way up to corporations of $30 million. So a large range of businesses she can work with. She has a lifelong dedication to serving the community as a Rotarian, a member of the board for the Habitat for Humanity and the North of the River Chamber of Commerce. But her biggest passion is the book club she shares with her 2 granddaughters, Ella and Camille. Michele, thank you for joining us today. Welcome and take it away.
Thank you for having me, Kelly. Really appreciate the opportunity to share this great line of credit that we have at Pacific Western Bank. The target market for the line of credit is companies that have been in business for 3 or more years, and they have not exceeded $1 million in gross annual revenue during the last 3 years. And the reason those limitations are on there, on this particular line, is because the bank created the product specifically for small businesses. The underwriting, so to speak, for these lines of credit is a lot easier than it is for businesses with a gross annual revenue over $1 million. So normally, if you've ever applied for a loan or even a credit card, you have to provide your personal tax returns, your business tax returns, your financial statements, personal and business, and of course the entity docs for your business. But on this line of credit, we determine the line amount that's available to your business based upon your average deposit balances that you've kept in your account during the most recent 90 days. So basically, it's the bank's way of recognizing that you're managing your cash in a positive way. So the maximum line amount is $100,000. We determine your line amount by multiplying your average balances in your business checking, business savings, and sometimes even in your personal deposit accounts. We multiply those averages by 2.5 times. So if your average balances are $20,000 in your business checking, business savings, if you're a sole proprietorship, we would include your personal, then you're going to get a $50,000 line of credit. Regardless of the amount of the line that we approve you for, we always throw in, so to speak, an additional $10,000 of on an overdraft protection line of credit. So speaking of the overdraft protection line, you have to have a checking account with Pacific Western Bank in order for us to implement the line of credit. So I don't ask you to open up the checking account until after I have approval for your line. Some of the things that we take into consideration in approving your line are your credit history. We don't look at all at credit scores, but we do look to see if you have had within the last 5 years any of the principal owners. We look to see if there have been any foreclosures or short sales or bankruptcies. In the instance, let's say there was a bankruptcy 6 years ago and it was due to medical issues, then we can probably, approve that line for you. Once you're approved, I would ask you to open up the checking account with us. And then at a time when you would need to make an advance, you would just call. If you called me or some of the other support staff in my office before 3 o'clock, the money would be in your account the same day. The purpose for this line of credit is purely for operating expenses or cash flow. Same thing. So you wouldn't really want to use this line of credit to buy a piece of real estate or even to buy a truck, because the whole idea, as Kelly was saying, in using a line of credit, it's for short-term needs and you need to revolve it. So you call me, you make an advance, and let's say you need to hire another person because you've just signed a new contract. And so this is an instance where you're growing your business. So you signed a contract and you need to hire somebody. So you need to make an advance on the line of credit in order to pay this new employee to go out and do the work. And then once your client pays you, you need to pay the line back down. So the line of credit should be revolved. We don't really require that it rests at a zero balance for the whole year. I mean, for 30 days during the year, but you do need to, when you make an advance, when you can, you need to pay it down, because there's no sense paying interest on the line if you don't need to. Let's see, have I left anything out? So the application process is super easy. It's a 2-page application. That's the application right there. And if it's you as an individual or a husband and wife that are owners of the company, I just need one application filled out. If there are a non-spouse that's part owner of the company, then each of you would fill out the application. All the applicants are guarantors on the line of credit. And if you have your assets, your personal assets in a trust, the trust will also be a guarantor on the line of credit. Even though you're personally guaranteeing the line, the bank, we're not taking anything as collateral. So we're not going to file a UCC-1 filing on all your business assets. We're not going to take your home as real estate, as collateral. We're not even going to, ask that you put if you own your commercial building where you're running your business, we're not even going to ask you to put that up as collateral. So that's sort of another benefit of this line of credit, is that it's unsecured. And then, like I say, we don't underwrite your tax returns, your financial statements. As you can see on this application, though, down at the bottom on the left page, you do have to provide for us your most recent 3 years of financial information for the business. This application had 15, 16, and 17, but if you were applying today, we would need to have your information for 2016, 17, and 18. So on there, we would need to know what your gross revenues were for those 3 years. And that's where we're, confirming that your gross annual revenues were less than $1 million. If they were over $1 million, this is not the line for you. We also need to know your net profits and then cash balances. That basically means at the end of all 3 of those years, what were the cash balances in your deposit accounts for the business? And then if you have any securities in the business. To date, I haven't done one of these lines for a small business that actually had securities. So, if anybody's interested in the line of credit, or if you have any questions, you can always call me. My direct line is 661-378-1681, and we can get the process started. I would need to do a site visit to your company. Then, just get your completed application along with all of your entity docs, which includes your bylaws, your articles of incorporation, if you're incorporated, your fictitious business name statement, if you are a sole proprietorship, and what else? Statement of information that shows the officers if you're incorporated. So we just need your entity docs, 3 months of your most recent deposit statements for all of the accounts that you would want me to use in order to determine your line amount. So like I've been saying forever in banking, it's always better, and I think Kelly alluded to this as well, it's always better to have a line of credit before you need a line of credit. Even though it doesn't take that long for us to get this approved, if next week, somebody comes to you with a contract and they want you to start working right away, it's not going to be any fun for you to say, well, I've got to wait 3 or 4 weeks until I get my line of credit approved by Michele before I can hire somebody. So always best to get a line of credit. And like Kelly said, it's always best to start with the bank where you currently have a banking relationship. However, to my knowledge, there aren't any other banks in Kern County that have this line of credit. So feel free to give me a call if you have any questions. One more thing, Kelly talked about loan fees on a line of credit. This line of credit we do not charge any kind of loan fees. Normally lines of credit, there's a half a point or a point, which is basically like, 1% of the line amount. This line, we do not charge any points. There's a $200 documentation fee. And every year when we would renew the line of credit, we would, we'd have to submit a renewal application. You'd also have to resubmit your most recent 3 months of deposit statements so that we can confirm that, the line amount is still commensurate with where your deposit balances are being maintained. And then we'd also charge you another $200 documentation fee at the time that we renew the line of credit. Did I leave anything out?
I'm sure.
Let's see. Yeah, I think that's about it. So I'd love to work with you, and give me a call if you have any questions.
Well, I have some questions, and please don't wait to call Michele with questions. Go right to the Q&A section and ask her right now. We have time for questions. I have a few, and one thing I want to say also is that this is very common for a lender to actually base the amount of the credit line on a percentage. And in this case, it's a percentage of your holdings, your liquid assets in your bank. Other banks, they'll use a percentage of your sales. So if you're an online retailer and you're saying, gee, I'm going to get my fall shipment in, I need $100,000. it's unusual to go to the bank and say, hey, I needed a $100,000 credit line to do that, because it is going to be based on the revenue that you have in the bank, and then also your sales. So that's very common. We do have some questions that are starting to roll in. Keep those questions coming. I think we have a prize for the best question of the day. So we'll see about that. First question is, can I get a loan for both working capital and a line of credit at the same time?
Yes. Yes, absolutely.
Perfect. You can do that. And let's see. Paul asked, I had a BK 10 years ago because of the Great Recession. Am I bankable now?
You should be, yes. 10 years ago, so long as your most recent credit history doesn't show any collections or late pays. Like I said, we don't look at a credit score for this particular line of credit. Now, I have worked for other banks where if you answer, there's on the application, there's always the question, have you ever filed bankruptcy? Are you currently involved in any kind of a lawsuit? And I have worked for banks before where if you answered yes to either of those questions, we couldn't move forward. It was a done deal. However, at this bank, with this particular line of credit, like I say, we don't look at your credit scores. And if you've got a bankruptcy that's 10 years ago, we would consider, what your picture looks like now and take all that into consideration.
Michele, you mentioned your line of credit is non-secured. So what does it mean that it is secured by a trust or a other arrangement?
So the trust isn't securing it, the trust is guaranteeing it. So in other words, and the applicants have to personally guarantee the line of credit. In other words, we were alluding to 10 years ago, the big crash. When that happened, there were a lot of lines of credit that were only guaranteed by the business, not by the business owner's personal assets or their assets that they had in a trust. And because of that, the business owner was able to walk away and only the credit of the business was affected. So banks don't do that anymore. I mean, for the most part, any kind of credit extension now has to be guaranteed not only by the borrowers, the personal guarantees, but they also have to be guaranteed by the trust. If the borrowers have their assets in a trust, or the business happens to be in a trust, the trust must also guarantee. So when we take things as collateral, that basically means if the loan goes south, if the borrowers aren't able to repay the loan, then we would take over that collateral. For instance, previously I had borrowers who had a line of credit for several $1,000,000, and the line of credit was secured by the business assets only. And when the value of the business assets declined and it was lower than the amount that was outstanding on the line of credit, we actually took additional collateral and asked the borrowers for their trust to guarantee the line. And we also took additional collateral in that situation, which was their personal homes. So banks really never want to take over anybody's collateral. It's there sort of as an insurance policy that if the loan you know, if for some reason the business goes under or they get in a situation where they can't pay and, or they file bankruptcy, then the bank would end up owning that collateral. Did that answer?
I think that answered it perfectly.
Okay.
Well, on a happier note, if my loan is approved, how long does it take to appear in my checking account?
If your loan is approved, it takes up to 3 to 4 weeks for this particular line to be approved. And then you just call me and say, I want to advance $10,000. If you call me by 3 o'clock, the money will be in your account the same day. If it's after 3 o'clock, it might be in your account the same day, but possibly the next day. And then I always give you a call or an email to let you know when the funds are in your account. So
the next question is, I'm thinking of applying later this summer. Will you need my 2019 net income information to that point?
no, we just need year-end numbers for 16, 17, and 18 on your application.
Okay, that's good, because a lot of lenders will require a interim statement for profit and loss and also a balance sheet. So next question is, what would work best for a lease on building or property? Loan.
Well, if you're making monthly lease payments, you would need, if you're making monthly lease payments, that's considered operating expenses. And so a line of credit would work, but only for the short term. I mean, you need to be able to afford whatever that lease payment is going to be.
Yeah, so it typically comes out of, it will eventually come out of cash flow.
Right.
So I'm thinking the question is maybe initially, what would be the best way to fund, maybe before revenue gets up and cash flow generates? And if that's the case, probably a term loan. Or perhaps a line of credit under some other scenario.
Perhaps.
Depends on, we need just a little bit more information on that one. So hopefully that helped a little bit. If you have any questions, any of you that we don't answer your question thoroughly or anything, please contact us afterwards and we'll do our best to follow up. What are the details of acquiring a working capital small business loan, and what are the amounts available?
This line of credit is for working capital. I think you might be asking about the mid-state development loan.
Well, it's working capital for small business, and what are the amounts available? So I believe there's the term loan that we talked about, because permanent working capital is kind of the basis for starting out. I think it depends more on what stage of business activity are you at. If you're a startup, it would be a term loan, and it would be mostly, you know, for working capital to get up and going. If you've been in business for 3 years, then what you're going to want to do is contact Michele and see if the credit line is the better vehicle for you.
There, for the startup loans, it might be the loan that you talked about, Kelly. Banks don't generally have loans for startups.
Startups are tough.
Just, yeah.
Sometimes, like with a micro loan program,
Yeah.
we can find debt.
Angel financing.
There's some investor, friends and family, but sometimes the CDFIs with a startup will do something. Depends on the situation. And unfortunately, unlike all business financing, there are so many variables that go into it. It's really cookie cutter is hard to define at times. So hopefully that answered some of your question, and a lot of it actually. And our next question is, I'm going to try to short this down a little bit. It's a long question. It's attendee who's wanting to start a food business with great credit, and they have some money, which is always good because capital, and when you're wanting to start a business, generally a lender doesn't want 100% financing to go to you anyway. So it's always important to bring some to the table, and having money stashed up for your personal account is good. So we have a person starting a food business with good credit and some money to put into the business. Want to establish a line of credit for operating expenses when you open the restaurant. No previous business activity or assets, probably not going to use it after a year because, and that's typical with this type of a business. A business starts up as a restaurant, people find out about it. So oftentimes it takes a few months to generate that. So my part of the answer to that is going to be permanent working capital is best. That's the good news. The bad news is startup food businesses are very difficult to get financed. Very difficult. And I could even go back to a family member of mine who went through the same experience 4 years ago. But there are ways that you can work around it. There's a lot of creative ways. In this particular example with my family member, crowdfunding was an alternative. And being able to crowdfund and generate excitement between friends and family and others in the community and get that rolling. There is a group called the Opportunity Fund, and their sweet spot is around $30,000. So if it's a very small startup food business loan, they're out of the Bay Area, we can put you in contact with them. They're an option. So there are options. Typically, a lot of your traditional banks and also even some of your government lending programs, since it is, food businesses are a tough business, and there is problems. So
our startups.
So that's my part. Michele?
I don't have anything to add.
Thank you. So hopefully that answered your question. And I think you do go on to realize that you will, and it's oftentimes just needing that permanent working capital. And let me define permanent working capital for just a minute. And permanent working capital is that base of money that you start with for working capital in your business. And what you'll see is even very successful businesses, when they start up, their money is going out to grow that particular business to where they don't really take a big profit. They're plowing that money back into their business. And that working capital is to pay those bills while money is coming in. So it works the same way, but that base of permanent working capital, as we call it, is vitally important in having that money to work your business from a financial standpoint. So I think we answered that one. Next question is regarding rates, business rates. What is the current average rate for your business loans?
7.5%. It's variable. So it's currently 7.5%.
So it's currently 7.5%.
For the line of
credit. And what is it that tied to?
It's tied to our bank rate, which is 75 basis points above prime rate.
Okay. So that actually, if you ask me, is a good rate. People
it's
get
better than credit card rates.
It's better than the 18 to 21% you'll see on a credit card, and it's better than the 40 to 60% rates that we've seen from some of the online lenders. So yes, that's an attractive rate. Oftentimes people will come in here and we'll talk to them, we'll say, hey, the going rate for this is 7.5%, 8%. And they'll go, wow, because people have got tied into these low interest rates, particularly on mortgages that were down to 3%. And a mortgage loan is always going to be cheaper than a business loan. In every instance, it's going to be cheaper unless, of course, you have a rich uncle. And if that case, that's your lender. So, seeing no other questions, and we're about running out of time anyway, I would like to thank our guest today, and let me go to her slide right here for more contact information. There you go. And contact information there for Michele McClure, her phone number at Pacific Western Bank. Michele, thank you for joining us today, and thanks for having such an attractive loan program. The credit line is a great program for people that fit that particular need of being in business and needing a small interest rate loan. So thank you for joining us.
Thank you for having me. Appreciate it.